Life runs on the same rules as the financial market. And the first rule is one nobody escapes. Bull and bear cycles aren't random. They are structural. They are inevitable. A bull market isn't proof that things are generally good. It's proof that greed has been pressed into expectations. When an asset climbs to dizzy heights, the risk is already baked in. The people buying just can't see it because they are busy watching the numbers go up. That's what greed does. It doesn't block your vision, it reorganizes what you are willing to see. Good news sharpens, warning signs blur, until one day the trend breaks, and every signal you ignored becomes impossible to miss. Not because it wasn't there, but because you choose not to look. Bear markets are the flip side. Prices don't collapse because value disappears. They collapse because fear takes over the controls. Nobody's reading fundamentals anymore. Everyone's watching the same candle keep moving down. The cheapest assets in the market are sitting right there, but nobody touches them because fear turns every low into a preview on something worse. The cycle isn't the market changing. It's human nature swinging between two extremes. Greed beats the top, fear hammers bottom. Every cycle, no exceptions. That's also how life plays out. Before you walk into the exchange, understand the structure. Everyone in the secondary market enters with a price set by the primary market. Your IPO valuation wasn't your call. The family you were born into, the era you entered the workforce, the industry you landed on your first job. That's your issue price. You didn't choose it, but it sets the cost basis for every move you make afterward. And the secondary market was never retail traders going up against each other. Institutions and major players are the ones making the market. The price action you see, the chart, is the footprint that leaves after their positioning is done. By the time retail sports the signal, the smart money is already looking for the exit. In real life, the institution and the capital structures, industry dynamics, and the resources system that operate well above street level. They don't announce their moves, but every shift they make redraws the boundaries of what an ordinary person can actually work within. Fighting that current drains you. Pretending it doesn't exist is its own kind of arrogance. The only move that holds up is reading where the flow is going and executing well within the space it loves. In trading, when KDJ pushes into overbought territory, K and D boost above 80, it's not telling you the relay is strong. It's telling you the relay is running on borrowed time. But at that point, nobody is checking the indicator. The account is up. Everyone around you is counting gains. The only thing is in the room is it can still go higher. That's exactly when the major players finish to offloading their positions to the wave of the buyers rushing in and quietly stop back. When things are going well in life, you are that late buyer. You just don't realize it yet. You've seen this person, business cards on their third redesign, new ventures stacking up, calendars packed solid, every post online is deal closed, funding secured, another launch. The feedback is entirely positive, and everyone around them is reinforcing the story. So the brain does what it always does near the top. Quietly removes the luck from the outcomes and flies everything under personal ability. Not deliberately. It's just what the mind does to stay coherent when everything is working. Judgment starts drifting. Commitment stretches past capacity. The whole operation is running hot underneath. But the numbers do look good, so nobody stops. The first thing that actually breaks isn't the business. It's the body. Sleep gets compressed. The mind kicks on the moment the eyes open. Meals happens between calls. Waking up at 3 p.m. to check messages, the body is throwing out every signal it has. But one sentence shuts all of it down. This is critical stretch. Push through it. And just like that, the body stops being something you live in, and it becomes something you run until the plane gets down. At that point, you are not running your life anymore. You are being carried by the momentum, and because the chart is still moving up, it doesn't feel like a problem. When the bear market hits, the most expensive mistake isn't selling. It's holding on. Down 20%, waiting. Down 14%, still waiting. After a while, you are not waiting for the recovery. You are waiting for a version of events where you don't have to admit the call was wrong. Every moving average broken, MACD crossed down, volume drying up, every signal pointing the same direction, and still the position stays open. Because closing it turns the paper loss into a real one, and a real one means facing something you'd rather not face. Then comes the move that turns a bad trade into a rigged account, averaging down. Add here, lower the cost basis, waiting for the bounce. Sounds reasonable, but the decision is coming from analysis. It's coming from the part that refuses to accept the loss. So you add. It drops further. You add again. What started as something manageable compounds into something that cleans you out. Be honest with yourself. Have you run the same playbook somewhere in your own life? Things start slowing down. Energy drops. Sleep goes sideways. But instead of pulling back, the response is pushing harder. Longer days, more commitments, a schedule packed so tight there's no room to think. Not because it's working, because stopping means sitting with something uncomfortable. The same reflex that keeps a losing trade open keep a person grinding past empty rather than stopping to look at what's actually happening. Sunk cost isn't just a money problem. It lives in the identity you build around not being the person who got it wrong. What actually keeps someone in the market across the multiple cycles isn't getting the calls right. It's whether the losses have a ceiling when the calls go wrong. In trading, that's a stop-loss line. In life, it's an honest read of your own condition. Position size changes how you think. Carry too much and the weight alone warps the decision. Heavy in a trade, can you still sleep? Leveraged, can you still look at the chart without seeing what you want to see? That's not abstract. It's just how it works. The body is the same system. Someone running weeks of broken sleep making decisions that matter is no different from a trader deep in a losing position. Clicking without thinking. Both are running on something already bent out of the ship, trying to handle a situation that needs a clear head. A margin call triggers when the account falls too far. The body has its own version of that line. It just doesn't come with a notification. The people who come out of both bull and bear cycles aren't the ones who caught the turns right. They're the ones who checked their actual condition before every major move. Not the number on the screen, but how much they genuinely bet left in the tank. Your most valuable asset in this market isn't your position size. It's whether the person making the calls is still thinking straight. The position survives. You are still in the game. When the cycle turns, the position blows up. The next move has nothing to do with you.